For leasing, there are two accounting treatments for leasing under US GAAP. One is operating lease, the other is capital lease. And in this example, we will investigate what's their difference. For capital lease, actually the company should meet these criteria. Okay, so we based on this lease amortization table. So this is a lease with 3-year term. Okay. Each year the lease payment is evenly $18,095. So the total is $54,285. And the effective interest rate, the discount rate, is 10%. So if we calculate the present value of these three cash outflows, it just equals to 45,000. Actually, the 45,000 is also the book value of assets at the beginning of year 1. And this table shows how the book value of lease liability is being amortized. Okay, finally the lease liability will be 0 because the lease payment has been complete. And this is interest rate, which is a product of 10% and the book value, or the amortized value. And this is amortization, which is a difference between payment and interest expense. Okay, for operating lease, it is quite simple. Accounting treatment is we just recognize the cash outflows and also leasing expenses for each year. Okay, so the total of the 3 years are $54,285 cash payments, and also recognize $54,285 rent expenses. The next one is capital lease. Because capital lease considers ownership is to the lessees. Okay, so the lessee should recognize the assets because it is considered as owner of these assets, and also the lease liability. Okay, this one. And also in the first year, at the end of the first year, company is going to amortize the lease liability. Right? There's a cash payments, lease liability reduced, and also recognize the expense. Because the lessee owns the assets, so lessee also recognize depreciation expense. This is a simple example. We just assume the company, the residual value of the fixed assets is 0, and we use straight-line depreciation. So for each year, the depreciation is 15K. So each year, the company will recognize the accumulated depreciation of the leased assets and also depreciation. Right, and we follow the schedule to do for the next 3 years. What you find is the accounting treatment is different. Okay, so you can use either accounting treatment for a single lease agreement, but there is also requirement, as I mentioned at the beginning, for capital lease, the company should meet some criteria. But for the accounting, if we sum the 3 years, we find there are basically no difference, right? So the cash outflow, $54,285. The difference is for operating lease, the company recognizes rent expense. For capital lease, it recognizes depreciation plus interest expense. Okay. So because the existence of these two different accounting treatments, so different firms may choose different accounting for their lease. So to make company's financial statement comparable, so we should change a way, like to make their financial statement comparable, we should use a method to convert all the operating lease to capital lease. Okay, so that all the companies, they are considered to use capital lease for all the leased assets. Then there will be no difference between, firms regarding the accounting treatment. So their financial statement is more comparable and more useful.